What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. Basically, just want to go over a recent speech, probably about 2 weeks ago, of again Governor Christopher J. Waller, of Fed Governor, I should say. Um, Basically talking about the risks in the crypto market. Which I always, whenever you have markets like this, it's always just kind of a matter of time before some government tries to go in. Now, the Fed's technically not really government, but you get the point. Before there's kind of a push towards this form of regulation. And his kind of main line of argument really follows along the same, it's the same thing as has been throughout history on why certain markets need, or not even certain, why markets in general need regulation and so on. So we'll head up right over to the screen share just so you guys can see as well. Go over there. Boom. I'll make sure you guys bigger for you guys. So hopefully you guys can actually see it. Um, okay, so the main issue in crypto asset regulation isn't how to protect sophisticated crypto investors, it's how to protect the rest of us. Way to be cliche. It's pretty much always the argument they use. So, by law or by practice, many crypto related products and activities fall between the cracks on traditional legal and regulatory structures outside the so called regulatory perimeter. In that environment, the normal backstops and safety nets of traditional finance do not necessarily or reliably apply. High volatility is the rule, not the exception. Fraud and theft occur regularly, often at large scale. Your whole pot is always on the table. You take part at your own risk, right? So, some of the things to point out that I always love to when it comes to stuff like this is, so mostly this last couple sentences, right? So, fraud and theft occur regularly, as if crypto is like the only place that like, what do you think the US dollar is? Like, how much fraud and theft occurs in the US dollar? Not just because it's the world reserve currency, but even just, I mean, it, it's going to occur regardless. And so whenever something like that is always just thrown in there, yes, like of course it happens, but it's also like, I mean, what are you going to do about it? Regulate the hell out of it? I mean, apparently that's always the answer. Um, it's always kind of the go-to excuse, I guess. Um, And we'll get into a little bit of where he's talking about, like, it's not the sophisticated investors that really want or need the protection. It's always the little guy, right? Um, which also raises the question, why don't they just make it possible for only accredited investors, or at least specific aspects, right? Kind of like you have with like real estate or whatever, or where there's certain things or certain investment things that you have to be accredited to participate in, but that kind of inherently requires regulation. Um, so it's kind of goes into the nuance, and if they're going to actually regulate everything, then how are they going to do it? But that's a separate topic. So in each case, this was a quote from, it says, Professor Deborah Spar. Basically, in each case, the technological leap also creates a political gap. Innovation, in other words, enables firms to play in some new sphere of activity, free from the rules or regulations that might bind them in another, more established realm. So essentially, whenever there's technological advancement on some form to a significant degree, the people who are actually doing it, who are much more acquainted with not just the technology, but the concepts and what's going on, that they're always like one step ahead of regulators. You see this in the banking sector all the time. Um, Regulators just can't keep up, um, because they there's so many different things that they have to regulate that they can't really specialize to the same degree. And a lot of it has to do with, I think, the fact that the regulation comes from the public sector, which is kind of the definition of the regulation in a form. Whereas you're not having the entrepreneurs and such doing it. And so those are the ones, it's the people who are actually doing it every day, the experts, that they're building the foundation for this. And so, and this is not just specific to crypto markets, this is specific to anything. Um, for example, like the way I kind of slid into this little aside is with the banking sector, right? And so this is what they do. It's like they can pretty much always get around the regulation if they really want to. Um, and there's always I don't hmm, some form of interaction with the government, but that's kind of a further topic, I guess I should say. But either way, you can't really argue that that doesn't happen. Um, basically, the fact that the people doing it every day are going to be ahead of the regulators is what I mean. And so the ideas, practices, and technologies that survive in these rough waters can eventually disrupt and improve older and calmer markets. As as he's said previously in the context of stablecoins, those positive spillovers can, under the right circumstances, make everyone better off. So the whole point is innovation, right? So it improves the older markets. And so it's kind of equating calmer as better in a way, but that it really depends on where you're putting the value, right? And so is it really, the steady, quote unquote, hopefully maybe increase um, of GDP or of quality of living or whatever? It's that steady rate that really defines the value, or if it's like, if it's just the increase in general, whether or not, because nothing really goes up in a straight line. I mean, look at pretty much any stock chart. um, and pretty much any economic chart in general, it's like it very rarely goes up in a straight line unless it's kind of defined as such, as you sometimes see with like policy rates. I mean, they don't go up as a straight line, but you kind of have the step function because they raise it, it's at that level for a little bit and they raise it again or whatever. There's kind of a defined function depending on how you're defining said rate or said indicator or whatever. Um, but anyways, here he says experienced investors know what they're getting into and that they're not asking for protection because they believe they don't need it. Okay? And so, I mean, that's the whole thing too, is like with free markets. Or in a true free market, you would have the people who excel in whatever subsection of the market would be the experts in it, right? Because they know what they're doing. It's the people who always dive into stuff who don't know what they're doing that get hurt. And the difference is with experienced people, if they get hurt, they can typically figure out why, and they're better off from that. They've learned something. And yeah, it'll hurt, but it's the people who don't understand what they're doing. Like that's the problem. It's the education and everything else. I mean, that's why it's kind of a common theme in a lot of the videos I've done throughout the past year, to where you have to be educated on this stuff. If you're going to delve into something, you have to understand it. I mean, especially when it comes to finance and your specific personal finances and stuff. Like, it's one thing I tell people that ask me questions about this stuff all the time is, you know, they'd be like, should I invest in the stock market or crypto or whatever? And should I buy Bitcoin? I was like, well, have you looked into it? Like, do you understand it to any degree, right? And if the answer is no, then it's like, "No, probably not." Unless you're willing to learn about it. Like, for example, my dad was asking me about Bitcoin, and I'm not a huge crypto guy or whatever. I mean, I have some, but it's not a big portion of my portfolio or anything. Um, and I was like, well, if you want, I'd probably put, I was like, if you want, buy a little bit of Bitcoin, like very, very little. And then just because now you have some skin in the game, and that'll kind of incentivize you to learn more about it, right? Because that's what really matters. And the more you understand about it, the more you can see the nuances. And it's like, for example, with cars, I've noticed this with myself, right? The more I understood about cars and everything else, I became much more comfortable with my own. And what I mean by that is like in high school and in college, I was always borderline paranoid to make long trips because I drive an older car, and everything else. I mean, like I walked to work until I could buy it and everything else. And like that's my car. And so it's like I can't at the time, um, I couldn't just go get a new one or not even a new car, just like a new used car for a few grand because I was still in college and everything. It's not like I had a lot of income. So I was like, I don't want to do these because I'm paranoid it'll break. And the more I've studied it, and the more like because I also like I love cars, and so the more I've learned how everything works, the more comfortable I'm like with taking those long trips. Because if something goes wrong, I can either I know enough to where I can either figure out what happened, I can fix it right there, or I can take it to a shop and be like, this is what's wrong with it. I just don't want to fix it. Which is typically what happens because I'm so busy and everything else is if something happens besides like I need to do like change the oil or whatever, like tiny things that take a little, not even like 30 minutes that I can do myself, then I'll just do those because I enjoy doing it. But say like if I need to replace my transmission fluid or basically get new tires or whatever. Not even just that, but like little things like servicing the coolant system and stuff. I'll just take it to a shop because even though I can do that myself and I know how, it's just so much better to just push it off. Um, but anyway, I'm more comfortable with it because I understand it more. And the more I understand and the more I learn about it, the more comfortable I am with it because you understand the nuances and it can be more dynamic. Same thing with investing or in various things. The more you understand something, the less risky it is, right? I always viewed those long car trips as a major risk because I didn't understand my car. And so I couldn't it was much more risky from my perspective to do those because I couldn't deal with the consequences. And it's the same thing with investing in terms of the risk is not a function of the investment, it's a function of the investor. I think that's borderline quoting one of Robert Kiyosaki's books or something in that realm. I don't remember the exact book. It's just a concept that's still in my head, and that's one risk management is a major thing. And that's the problem is people, retail investors, for example, in this specific case, aren't they don't understand enough to, or they're not willing to educate themselves to the point to really do an adequate amount of risk management, and that's when you end up getting hurt. Um, anyways, more than 90% of these adults held them for investment purposes rather than in payments, and so basically, this is going on their survey of household economic decision making, right? They found that 12% of adults used or held cryptocurrency in the past year, and then 90% of those did it for investment purposes rather than using it as a medium of exchange, as it's so called defined, right? And this is where we're kind of getting into the argument of whether or not certain um, like crypto coins or whatever should be defined as securities. I think it's called the Howie Test. I think so. Um, Basically defining what a security is, you know, um, and then from there, if it passes the Howey test, it's therefore a security and therefore needs to be regulated by the SEC, right? So it's like the Securities Exchange Commission. Okay. So now we're talking about the losses. So what happens in the aftermath of these losses and on an individual level? One possibility is a dispute between the intermediary and its customers over poor due diligence, poor financial advice, poor management practices, and so on. Resolving these disputes individually can be costly. Basically, talking about it from an intermediary's perspective. So when you have retail investors who don't know the difference between like they don't know how to write a smart contract or use the DeFi protocols or obtain and protect private keys, just keeping with the crypto example. Then you have these businesses who basically they see a need and they fulfill it, which is there's nothing inherently wrong with it. I mean, that's the point of the business. That's the point of a business is to fill a need, right? Or provide a service. Um, so that's all they're doing. And then, so you see on one side, the regulation comes from those businesses who are wanting it to protect them, and then from a social perspective, you get the other side when you're dealing with actual investors and investors themselves, the retail people who are coming in there. So from a social perspective, there is another possible outcome where losses become widespread. These losses become practically, politically, and morally intolerable. So when everyday investors, retail investors, start losing their life savings for no reason except wanting to participate in a hot market, demands for collective action can mount quickly. History shows that there will be demands to make individual investors whole by socializing their individual losses, right? And so basically, you see, the whole point in the founding, or one of the, let's go with, one of the main arguments for the Federal Reserve System itself is basically to socialize the losses of the bank, right? And so that's why you see the amount of bailouts that you do, because you're having kind of a partnership, a cooperation between the private banking sector and the government, to where when private banking goes under, the government comes in and bails them out because they're too big to fail, so to speak. That's one argument for it, right? Um, which kind of a related topic. I did a video earlier this week where the Fed did their kind of annual simulation, or whatever you want to call it, the stress test they do on banks. And you see that most of the very well-known banks like Bank of America, is it Citigroup, Barclays, Goldman Sachs, and a few others, um, basically didn't pass the stress test and were deemed to be kind of uh, how to put it, vulnerable for a global market shock, is I think how they uh, said it, how they worded it. And so I'll put a link to that video, because in the description of that you can also go to the source. That's the reason why I put the sources and where I'm going for all of the stuff in the description, so you guys can actually look at it yourself. That's the whole point. Okay, so to continue, so it's not to protect high net worth investors, but to protect society from the often irresistible pressure to socialize the losses of investors with limited resources and to limit the spread of financial stress. And so basically, they have to prevent this socialization of losses, instead of just not doing it, and not having um we'll go with investors with limited resources, to use their term, retail investors, to kind of demand, to prevent these retail investors from demanding a socialization of their losses. Um, Basically, regulating the markets to prevent that. Um, and so you're not really having, instead of just, like having them actually learn, or preventing or providing the incentive for them to educate themselves in whatever they're happening to be doing, in this case crypto. And I'm not saying that to be, not meant to be condescending, because in this specific example, I mean, that's the major reason why I'm not heavily in crypto. I don't deal with it, is because I'm not very educated in the topic. It's just not something I'm interested in. And so, I mean, like, I'm interested in like Bitcoin and the theory behind it, and kind of the whole sound money and all of that libertarian stuff that you get along with that. Um, which is why I have some of that. But I'm not dealing with altcoins or anything else, and I don't have any significant amount of my capital within that industry, because I don't have the education, or I don't really want to go that far in depth with it to a certain extent. I feel like my time is better spent elsewhere. Um, just from my perspective, I have other things going on. Um, and so, so for to use that as an example, that's why I'm not in it. And so that's why, like, hmm, that's the incentive to not have the regulation, right? In that respect. Didn't word that very well, but hopefully my point came across. So, to continue, by definition, these financial externalities, which central banks, including the Fed, monitor closely, can create losses that innocent parties never signed up for and couldn't have controlled. They didn't sign up for it, they shouldn't participate in the market. Um, those are the kinds of losses that the public often gets asked to cover. And when they do, very often the public also asks for new oversight and regulation so the same mistakes don't happen again. Same narrative. But in summary, financial regulation is typically demanded by the financial intermediaries, businesses and such that actually help with in this case, like smart contract transactions and so on. Um, Basically, the ones helping the retail investors. And then liability protection is the name of the game in case they lose everything. And so by the taxpayer to prevent socialization of individual losses, right? So, anyways, I'm going to stop sharing. But yeah, it's pretty much all that comes to mind with the risks of the crypto markets in terms of Fed Governor Waller's speech. So, I mean, it's kind of the same argument that you see with basically any financial market whatsoever throughout history of why it needs more regulation. Like it's the same line of logic. So I guess historically it's nothing new. It's just now it's being applied to crypto. Um, Big surprise. But anyways, I'm gonna leave it there. So I hope you guys have a good night.